Nifty closed the previous financial year at 22,325, approximately 22,350, and it had made a high of 22,500 plus. And currently it is trading at 23,350, as we can see here. So there's, for all the hype and for all the bullish potential that this index has, the index has actually year to date returned less than 4% or 3%, which in most cases is lesser than an FD interest rate. So, arguably, what a lot of brokers have said in the past, that most investors and traders fail to beat interest rates, is pretty reasonably apparent from the price action that we see, or the manner in which the last 4 months have traded below, the last 4 months have traded earlier, in which Nifty has given up a significant percentage of its gains, and to give very muted returns for the year. Having said that, we have had a few major events unfold, one of them being the budget. And the question is, with this unfolding of such a major event, which was in all likelihoods a very dovish budget, could this potentially change the trend of the market? To answer that question, I believe that the trend of the market is still structurally up, and how I will determine that is by simply adding a moving average, and I will simply select, let's say, a 20 period moving average by clicking here, and for some reason yeah, and maybe make it a little dark and have it red, and have a simple rule saying that as long as the market trades above this red line, it is my view that the market is basically trending bullish strong. And how does one approach a bullish strong market? My answer is fairly simple. We have to buy the dip of a bullish strong market. Now the question, another question could be, is there any justification on making this assessment on the monthly time frame? And my answer is yes, there is a justification, and the reason for that is increased trading cost. And increased trading cost is basically an incentive to reduce the frequency of trading. So, like all businesses, trading is a business, and like all businesses, our primary intention has to be to keep the cost at a minimal, and yet keep the business a going concern, so that the upside potential is not restricted. Earlier, when trading costs, where it was structurally cheaper to trade FNO as compared to equities, it made a lot of sense to trade these instruments and to trade them often. Now, the trading costs are so high that there is very little incentive to be in the FNO market, with the exception of leverage and the potential to sell. So, keeping that in mind, the primary reason why I have shifted my assessment on this particular time frame is, first of all, the market is clearly trending on this time frame, which justifies any buying decision that I make, despite the fact that we are seeing a significant correction, particularly in the last 4 to 5 months. So, despite this counter trend move, there is a justification to make an assessment here for two primary reasons. First of all, a trend assessment on this time frame does not change easily, and secondly, there is so much efficiency when we reduce the cost. So if I were using cost as a barometer of efficiency, that is a way to measure how efficient the system is, in such a case, it is obvious that I want to keep the costs at a low. So now we come to the point that I would like to make is this the potential bottom? Are we looking at a potential bottom here? Now, whenever we are trying to answer that question, that are we looking at a potential bottom, in such a case, making analysis on the monthly time frame is quite redundant, because you can see even the next support on this is 4% lower at the index level, which is quite a bit. So whenever we are making a bottom recommendation, it has always been my opinion that we must shift our assessment to, let us say, for example, the daily time frame. The reason being is because we are looking to answer the question, is there any justification on trading on the long side, and the reason for trading on the long side is simply because the structure of the market is bullish. So the structure of the market, like I have, so I'll just copy this and paste this here. So because the structure of the market is bullish strong, which is something that we have already assessed on the very long time frame, we want to direct our shorter time trading in the direction of the structure, which is actually bullish strong. And now the question is, how do we determine, because the market obviously in its course of its correction from this level, which I will mark here, let's say with a darker line, and I think let's make it red. So since the course of its correction, where we are clearly seeing a high, we have seen market create multiple pivotal lows and fail them eventually. So we are here, now we are here. So I will just color these ones in a different color code, because these ranges are not applicable at the moment, and the only thing that a person who's looking to create positions now is looking to answer is, will this previous red line hold, that is say 22,750, 22,800 levels, and we are looking at a confirmation from the market to trade in the direction of the structure of the market. So let's see what do we have. So we'll just zoom in a little bit more on this, and we'll just focus on the previous lows. So obviously we can see that the blue line marked here is one of the pivotal levels, which has been established at the earlier part of the recording, and as we proceed we begin to start seeing a series of we first of all see a consolidation here. So let's say, for example, so that you and I are looking at the same thing, I'll just mark it here. From here till about here, we can see that almost 80% of all trading activity from this pivotal point has been tested here. And in this we are seeing a lot of potential support candles, which are tactical candle patterns. For example, I will select an arrow here and simply mark it from this point. We can, just as an academic exercise, look at naming this potential candle as a doji harami candle. So I'll just mark this one, right, and get this here, so you know which one I'm referring to. I'll make this black line slightly dotted, so we can see after. So obviously now one could argue if this big red candle, is it a bearish engulfing candle, and the answer is no, because the preceding move is downward, and when the preceding move is downward, it does not form bullish reversals or bearish candles. So this will just simply be ignored as an outside day candle, and prior to that candle, the green candle here, we can see which I'm marking here, is the confirmation of the doji harami, right? So I'll just mark this as a confirmation. So what was happening at this time? Let's just look at this movement here, right? So after an extended downward move of almost 15%, with a brief range in this zone which we have marked in blue lines, we have seen that the market gave just a two candlestick confirmation, which is a doji harami and a confirmation. So this is one of the potential signs that the market might slow down, and but the market didn't really slow down. I mean, it sold off after that, and after it slowed down, it formed another confirmation. Another bullish reversal candle, which is here, and obviously this is simply a harami candle. This is not a doji harami. So now we are seeing another candlestick pattern. We are waiting for a bullish confirmation of this one as well, and we get that. So I will mark another arrow here, and I will direct it straight to this point. This is the second confirmation, and instead of going up, we know that there was a gap down, which creates another pattern. So like I said, that when the structure has been moving down on this particular time frame, If there is a gap down, then such a gap can easily be termed as an exhaustion gap. All right, and whether it's a breakaway gap or an exhaustion gap, that confirmation will come from the subsequent move, which should be downward to the extent of this rectangle, but instead of that we get another doji. So I'll just I don't need to mark it, we can see there's a doji, and instead of that we get a gap up closing. So in the process, if you just ignore the doji, if you just can somehow ignore the doji, this has formed a morning star right about here. So I'll just mark this zone here and make a text as morning star, because we are seeing a gap down gap up kind of a scenario, and in between there is a doji, and this morning star of course is finds a confirmation the next day. So I will mark another arrow once again here. So we are seeing that this particular range has already been a triple confirmation of sorts of multiple candlesticks, and this one, the one preceding um, and the preceding candle, and that is the budget trade session, I think. This candle has clearly created a new high of this particular range, and today the market has consolidated downwards. So these are some of the reasons why one could feel that there is a potential bullish reversal. And whenever we want to identify what the market, whenever we want to identify a counter trend move relative to this time frame, because in the daily this is clearly selling, counter trend move, what we always want to see is look at volume confirmations. All right, we always want to see volume confirmations, and the reason for seeing volume confirmation is because volume is the only, or maybe I'll make it like this, is the only leading indicator of price. All right, everything else, every other indicator that we use, be it moving averages or be it oscillators or anything else, it is a derivative of price in isolation, but volume is the only tool which is independent of the price, and therefore the graph or the chart that a volume indicator makes is a subject of separate study. So we'll just add one of them. For example, my favorite volume indicator is on balance volume, and typically what we want to see is that till here I mean still the formation of this morning star. So just so to clarify, I will make a vertical line and I'll select it here so that we can see, and I'll darken this. Maybe I'll make it a blue line and make it quite dark, so you can see that this is the candle that we're talking about. Typically, because on this candle we are seeing a clear new low, the volume should also be creating a new low. So from reference, so for example, I'll write this here: if price low, then typically the volume should also create a new low. If price creates a new low, typically this is typically what we want, that if price creates a new low, then the volume should also create a new low. In the event that doesn't happen, if this does not happen, assess potential divergence. Yeah, so now we have obviously seen several bullish reversals potentially, and now we will just include the volume in this portion here. Just focus on the blue line, and you can see that this, where I'll mark with a black line right here, you can see that on the blue line, or maybe a better marking would be a vertical marking. I'll just check if it is possible to mark this here. Yeah, so you can see that on the vertical we can see that this is the low that was created, which is significantly higher. So I will choose an arrow. I think it will be reasonably visible to all. It is significantly higher from the low that was created earlier, and instead of making it dotted, I'll just choose a flat line right here. And at this point we are seeing that even though the market has not decisively broken the range, the volume has almost certainly broken the range it had created earlier. Yeah, so the fact, so hiding this, shifting it to the monthly, and removing all of this text from the picture, which is quite a lot of text. Just remove them. Sorry. Remove all of this and this. So you can see how small this is looking on the monthly. The fact that we have a bullish structure with on the monthly time frame, the time frame in which you're making assessment, and on shorter time frames we are seeing bullish divergences, and we are seeing volume create new highs while price is not creating new highs, backed by a series of small confirmations which are tactical confirmations such as candlesticks. There is reasonable justification, in my opinion, to anticipate the potential of a range break. That is the pattern that has been created on the daily. I will just try to, for some reason the net is slow. Once this opens up, so here, yeah. So now if we basically just try to look at the price action in terms of, if I simply make this and if I simply lead your attention to this point right here, that is something like this. So you will note that this is obviously creating the letter W at the moment. Yeah, this is obviously, so this is the lower low of this letter W, and at this point in time, in on a closing basis, the market has clearly broken this. I'll just take this a little lower so you can see it in this fashion. So clearly the market has formed a W pattern. I can even extend this, instead of here I can even extend this to this portion. So you will see that it's a proper W pattern, because the line chart was obviously drawn without using highs and lows as a reference. It is using closing as a reference. But if you were to use candlesticks, then such a, because when we are using candlesticks and candlesticks are measuring highs and lows, in such a case we are looking for patterns that are forming, factoring in the highs and the lows, and in such a case also you will see the formation of a W pattern. And now when we are seeing the formation of a W pattern, it is just pure theory. Like for example, the line marked here, we can see this, that this is approximately 23,350. We know that this is 22,750, and on the upper side we are looking at 23,450. So roughly 6 to 700 points upside target from this particular point should be placed as a pattern target. So opens up for a potential W pattern target. So how is this information useful for us? This information is useful for us because of the formation of a bullish reversal pattern on a structurally bullish chart with volume divergences. If you were considering either averaging, not averaging, I wouldn't say averaging, but if you were considering allocating some fresh capital or increasing your overall equity exposure in the market, then there is definitely a technical justification supporting that hypothesis. Of course, there is a risk that the market could, instead of going up, actually revert back to this range and trade here indefinitely. That is a risk. The other risk is that the market actually breaks this range on the downside. But like I said, that we have to, I mean, so when we beyond a certain stage, taking risks on surplus capital becomes a necessity, and market is only one of those avenues which allows us to take risks with surplus capital. There are obviously other avenues. If you feel that the candlesticks, that the arrows drawn here is more likely than my suggestion of the potential W pattern target, then obviously you would not be keen on taking long positions on the market. But if you were already predisposed towards taking long positions on the market, I think there is sufficient reason to preempt the full breakout of the W pattern, simply because volume has significantly broken from that pattern. And the last point would be on the certain tax reliefs on the budget. I was sent messages on how I see it acting, and if it will necessarily impact the Nifty FMCG segment in its will it necessarily impact the Nifty FMCG segment strongly? Now, this is the Nifty FMCG segment. Here I have once again put the structure. All right, I'm adding the moving average. We can see that while the segment has tested the 20 period moving average and Nifty hasn't, so potentially this segment is slightly more oversold than the market. So if you are bearish on the market, then this segment seems to be slightly weaker than Nifty at the moment. But similarly, because another way to look at it is that it is way more oversold than the market, and this is obviously a structurally bullish pattern, and my bias would be that when something has a bullish structure, generally the news or the outflows are in a positive direction and they should not come as a surprise. But having said that, does it imply that the budget will necessarily improve FMCG spending? So I disagree with that. That only FMCG segment will. In fact, the industry that, in my opinion, is most likely to benefit from this is actually the stock market itself, and it is also going to impact the banks positively, and it is likely in a direction to lower interest rates. And if at all there is a spending, it will be in the consumer durables, real estate, and which will consequently impact other commodities like say cement and other industries that align with it, and to some extent auto. That's the spillover auto, and to, I think, larger than auto would be media, but none of the media stocks which benefit from digital consumption are listed there. And the reason is as follows: that individuals who are earning a CTC of 12 lakhs and above, who benefit prima facie quite a bit from this, such individuals obviously have a PAN card, and there are very few individuals who have a PAN card who are not in the market. So it is very likely that the additional few thousand rupees a year that they might save um, is is going to be lying in the banks, which sort of increases the liquidity of the banks on a temporary basis. Uh, it'll take time to realize this, but the liquidity raises in the banks, and what this does, it lowers the interest rates, which makes this industry, the real estate industry, very favorable. It makes this industry very favorable. All right. And when there is money lying in the banks for sufficient long period of time, the other industry which benefits significantly is actually the broking and the stock market industry, and any asset management companies such as Anand Rathi, Motilal Oswal, etc., financial services firms which are basically selling financial products and services to their clients. They start benefiting significantly with this additional liquidity. And consumer durables such as which improve quality of life. So consumer durables which will improve quality of life would be things like washing machine, air conditioners, air purifiers, refrigerators, etc., which are tangibly improving quality of life. And of course, assets. Auto in general is an asset, although it is a depreciating asset. Assets in general benefit um, when the interest rates are lower. So I don't see how, let's say for example, government lowering the tax slab is going to increase the sales of Marico's parachute. I don't intuitively find that. I'm not saying that because of this it'll lower. That is certainly not what I'm saying. But that the change in the tax slab has a causal impact there to a very high extent. I do not. I think that's a little that does not make intuitive sense to me. But I'm obviously open to your suggestions on this. And on the other development, I think another chart that I would be interested in seeing would be Nifty Auto. And the reason that I would like to see this particular chart is because of the recent development. So obviously we can see this is stronger than the FMCG index. This is very bullish. It is at par with Nifty itself. But the recent development has been that prior to Modi visit to the US, and the current US stance on tariffs. All right. So India has already lowered tariffs for Harley Davidson, for example. which is basically the premium segment of bikes, particularly in India, and is at the moment it competes with I think Iker Motor at best, maybe say some other companies which are indirectly associated with the principal company. So now the fact that they have lowered this stance for Harley Davidson, in if it is done only for this, it is okay. That is, the impact is not much. But this position if this position of lowering tariffs is extended to the auto industry as a whole, then I think this is going to be extremely bearish for Indian automakers, because we must understand one thing, that let us say for example we look at a vehicle like a BMW or a Mercedes. So now the question is, why is it why is it a favorite or one of the most popular brands in the world? And the answer is because they offer state of the art vehicles, absolutely state of the art vehicles, for, let's say for example, anywhere between 10,000 to $50,000, right? uh, Anywhere between 10,000 to 50,000 USD, you can get absolutely state of the art vehicles of this particular brand, if tariffs are removed. All right, if tariffs are removed. So which means in European countries you will find, or in Dubai or UAE, countries which do not have this, um, who are not aspiring automakers themselves, and are not supporting their own industries internally through, let's say, socialistic or measures. Such countries you will find vehicles to be much cheaper, and consequently, if at under any reason, and currently at this 10,000 to 50,000 US dollar range, we have, let's say for example, M&M's XUV, series, the 300 to all the way to 700 series, and many Tata vehicles, Hyundai vehicles, Maruti vehicles, etc., which are in this particular bracket. So many automakers are in this particular bracket. If a BMW is to be priced at this value, I think I can take a safe bet that instead of buying an XUV 700, a lot of people would go for the equivalent version of a BMW or a Mercedes. It is because they are far safer, they have a much better engine quality, much greater comfort, far bigger brands, much more universally recognizable. So everything, and also they project image of success much better than most Indian car makers have been able to do so, and that has got to do with the high quality offering at the price at which they're offering. So Indian auto industry is one industry which truly relies on the control tariffs. All right, that is, it is one of the biggest benefactors of duties that India imposes, other than of course steel and other commodities. But when you're talking about a finished branded product, then autos are one of the industries which benefit a lot from this. And the recent development of lowering duty slabs, sorry, for Harley Davidson, if it is just to, you know, a gesture of goodwill before Modi visits Trump, and so that they can talk more progressively about better trade activities rather than controlled trade activities. I think it's a masterstroke to, because we have seen Donald Trump on his election campaign in podiums announce it, that India is a tough country to do business with for our auto manufacturers like Harley Davidson, simply because of, let's say, for example, the duties that they have imposed on them. And one of the things about being, let's say, for example, what's the difference between, let's say, president of the United States and you and me? What would be the difference? The structural difference is that if you were to become a head of a state, you are most likely going to do what you say. It is, a lot of people think that all politicians are lying and all politicians are, let's say, crazy, but they might be even true about it. But lie or crazy, eccentric is regardless. The fact that the individual has such a dominant position in the political scenario of the US at the moment, that individual can do anything and everything that he thinks and wants to put into action. He firmly believes that India is a big market. It has huge potential of people buying, let's say, for example, even two wheelers in the 10,000 to 50,000 US dollar segment, and that if and if their local manufacturers are placed with our local manufacturers for the same price, they're going to offer far greater value. So he believes that it is in their best interest and he's going to go in that direction. He has taken a specific name, and the Indian counterparts have addressed that concern by lowering duties by almost 20-30%, which means that in another, by next financial year or by next monsoon end, we should start seeing a huge drop in Harley Davidson prices in general. So, but Harley Davidson has a very small market share. Even if it grows at a high growth percentage, I don't think it is competing with Indian automakers just yet. But the company has the pedigree to be able to do that, and there are a lot of companies like that which exist in the world which can do that. And the only thing, or one of the most decisive thing that's holding them back, is obviously the tariffs on every component of the vehicle. And because of this high cost, the labor market required to service them is not developed to the level. So point being that the budget is very favorable for the country because of the reasons that I mentioned earlier. um, the government is spending on infrastructure quite a bit, contrary to what many people are saying that the capex on infra is low. It is, I think it's at an all-time high of 4.1 or 4.2% of GDP. That's at an all-time high. And the government is definitely anticipating an increase in revenue. So it's everything basically. This is perhaps the consolidation of almost 10 years of hard work. The government, at keeping constant infrastructure or marginally increase in infrastructure as in percentage to GDP terms. In absolute terms, of course, there is an increase, but in percentage to GDP terms means if they were building, let us say, 100 kilometers of railway tracks on X number of days, they will continue to do that. They are not planning to make it, let's say, 150 kilometers of track on the same time frame. That's not what they're planning to do. It means that most of their projects that they initiated are reaching a stage of completion. And and it means that the capital being allocated is to develop far more complex engineering projects rather than simply hitting a certain target. So there are a lot of implications of this. It's one of those very few budgets which has a very positive fine print, and it sets up the country. It sets up the monetary policy. We should expect the monetary policy going forward, if not the immediate one, but certainly, almost certainly this year it is going to happen. We should expect anywhere between 25 to 75 basis point cut in the RBI rates within this year. And that's largely going to be because, you see, when a lot of people have surplus money lying in their accounts, it lowers the risk of default in general for the bank, which lowers interest rates any which ways, and that will trigger consumption in other industries, not just FMCG. And the recent development on the tariffs of Harley Davidson, I've just shared because I once bought that bike, and I know how expensive it is to keep it. But regardless, I hope that I have shared a few points which might help you in planning of your trades going forward regarding divergences, W pattern, structurally bullish, etc. And I wish you all the best. Take care.